Welcome to the deep dive. We take your source material and, we help you unpack the most important insights.
And today, we're diving into a really interesting stack of analyses you've given us. It's all focused on several prominent dividend-paying stocks. Quite a range of sectors here.
That's right. We've got material covering Baker Hughes, Prudential Financial, AES Corporation, Verizon Communications, Ladder Capital, Dow Inc., Chevron, and Johnson & Johnson. So, yeah, quite a mix.
Yeah, and our goal here is really to cut through the noise in these reports. We want to pull out the key nuggets for you, what they say about financial health, dividend sustainability, growth prospects, potential risks, basically understanding what stands out in this specific material.
Dividend investing, it's often seen as a cornerstone strategy, income over time. And these sources, they really offer different perspectives on how these various companies fit or maybe don't fit into that picture. It's never just about the yield number itself, is it?
Absolutely not. It's the business behind it, the balance sheet, where they sit in the market. All of that really plays a huge role.
Okay, so let's get into it. Let's unpack this material together. We thought we'd start by spending a bit more time on Baker Hughes. The reports you included really go into quite a bit of depth there.
Yeah, they frame it as a company navigating a pretty significant industry shift.
Right. Baker Hughes, BKR on the NYSE, energy technology and oilfield services industry.
And looking at the data you shared, from around May 2025, we're talking a market cap of roughly $36 billion, stock price near $36.50. The reports mention a forward PE around 17.5 times, and a dividend yield about 2.3%.
Based in Houston, but yeah, totally global, operating in over 120 countries, the material definitely positions it as one of the big global players in its space.
And the main theme, really, running through the analysis of BKR is this big push to redefine itself. They're trying to move beyond just being seen as, a traditional oil field service company.
Towards what, exactly?
Towards being more of a technology-forward, diversified energy company. That seems to be the goal.
And the drivers mentioned are things like decarbonization, digitalization across the energy sector, geopolitical shifts too, building LNG infrastructure, using AI, those are highlighted as part of it.
Exactly. Now, looking at the recent numbers provided for Q1 2025, revenue was $6.4 billion. The reports note this was actually a slight miss versus estimates.
Oh, interesting. But the adjusted EPS?
The app beat expectations, came in at $0.51. But net income was down about 12% year over year, $402 million. And free cash flow also dipped, down roughly 10% to $454 million.
Okay, so why the dip in cash flow?
Well, the analysis points to strategic investments the company's making right now. That seems to be the explanation offered.
Got it.
But here's where it gets interesting, according to the reports. Adjusted EBITDA, that was up a solid 10% year over year, hitting $1.04 billion.
And how do they explain that jump?
The source is connected to good cost discipline and margin expansion, particularly in other key segments we'll talk about. And the order backlog also looked pretty healthy, $6.5 billion.
Yep. Okay. So the sources break BKR's business down into two main parts, basically.
Yeah, essentially. First, you've got the oil field services and equipment segment. They call it OFSE. That's the traditional core, about 55% of revenue. Drilling, well completion, that kind of stuff.
And the trends there.
The reports mention recovering rig counts, especially Middle East, Latin America, but North American shale activity, flat to maybe slightly down. They also mention using digital twin tech to boost efficiency in this core business.
Okay, and the second segment?
That's Industrial and Energy Technology, or IET. And this is clearly positioned in the material as the growth engine. This is where you find turbomachinery, gas tech, LNG systems.
But also the newer stuff.
Exactly. Carbon capture, hydrogen renewables, and the AI and digital services side.
And the growth drivers for that part are pretty significant, right? The LNG infrastructure boom is mentioned a lot. U.S., Qatar, West Africa.
Yeah. Specific contracts with Qatar Energy and Venture Global are highlighted. And the reports point to a 12% year-over-year jump in gas technology sales.
Plus the AI diagnostics.
Right, through their Baker Hughes C3.ai platform. The analysis you shared is quite clear. BKR saw this multi-decade opportunity in gas and low-carbon tech early on. That's why IET is framed as the key for their long-term growth story.
So looking at the strategic initiatives based on these sources, big focus on the clean energy transition.
Definitely. Investing in CCUS carbon capture, utilization, and storage. They're apparently a founding partner in several hubs. Also mentioned are green and blue hydrogen and advanced geothermal.
Still early days for those, the reports say?
Yeah, described as early stage, but potentially transformative down the line.
And they're heavily involved in LNG and gas tech, too, viewing natural gas as a bridge fuel.
Absolutely. Supplying compressors, turbines, engineering for these massive projects. The material highlights specific recent wins: Venture Global's Calcasieu Pass expansion, Qatar Energy's North Field East, projects in Angola, Mozambique.
And the digital side, that BHC3.ai platform with C3.ai and Microsoft Azure.
Yeah, offering things like predictive maintenance, asset management, emissions tracking, even AI for supply chain forecasting. The reports see this digital push as a way to boost recurring revenues and improve margins.
The analysis also touches on competitors. Schlumberger, Halliburton, Technip-FMC, Honeywell are named.
Right, and BKR's strengths. The reports highlight its diverse global customer base, strong R&D, what they call the broadest LNG compressor offering globally, and deep ties with national oil companies.
But there are challenges noted, too.
Yeah, potentially less pricing power compared to, say, Schlumberger in some markets. Yeah. There's a risk investors might be a bit confused about this transition in the short term. And, a complex global supply chain is always sensitive to geopolitical stuff.
Okay, let's shift to valuation and what the analysts think, according to these reports. Mid-May 2025, trading around $36.50.
The forward PE, about 17.5 times, and EBITDA near 8.5 times. These are seen as relatively attractive compared to peers, especially given that potential growth exposure in the IET segment.
And analyst sentiment.
Generally bullish, seems like. The average target price mentioned is around $48.53, which suggests, maybe 33% upside from those levels mentioned. But the material definitely adds a note of caution. Near-term oil volatility, trade uncertainty.
And the dividend specifically pays $0.21 per quarter.
Yep, that gets you the 2.3% annual yield. The payout ratio is noted around 40% of earnings.
And management paused buybacks?
Yeah, according to the reports, they're focusing on strategic CapEx instead, which, ties back to that dip in free cash flow we talked about. It's going to investments. The dividend itself is described as sustainable for now. Potential for increases later if free cash flow picks up.
What about the key risks highlighted for BKR in the sources?
Energy price volatility is a big one. Demand is still indirectly tied to oil and gas prices. Tariff impact is mentioned too, specifically a 10% tariff on Chinese imports, potentially hitting supply chain costs or causing delays.
And the transition itself carries risk.
Absolutely. Transition execution risk, hurdles in perception, how they allocate capital, long payback periods for some new energy projects. Plus, operating in 120-plus countries means significant geopolitical risk, Middle East tensions, project delays in Africa, ripple effects from Russian sanctions, all that.
So wrapping up on Baker Hughes, the sources seem to position it for a really pivotal role going forward, more than just an oil field contractor.
Yeah, the bullish case outlined is driven by LNG's growth, CCUS hydrogen becoming more viable, AI revenues kicking in, margin expansion. Some views presented suggest the stock could hit $65 in, say, 3-5 years.
But there's a bearish case, too.
Of course. If oil slumps below $60 long term, if funding for the transition dries up, if digital margins get squeezed by competition, or if they just stumble on execution, then the stock could stagnate, maybe more, in the $30-$35 range mentioned.
So the conclusion in the material
is that BKR sits right at that intersection of legacy energy and future tech.
Yeah.
It's this balancing act, using cash flow from the old business, OFSE, to fund the growth potential in the new, IET.
And why it merits attention, according to the reports.
Strong order pipeline, leading position in LNG and gas tech, real progress in areas like CCUS and digital, valuation looks reasonable given the potential, and a sustainable dividend. They call it a compelling hybrid play.
Okay, that was a deep dive into Baker Hughes based on your material. Now let's broaden out a bit. Look at the insights on the other dividend stocks you included. The reports seem to use them as examples of different flavors of dividend investing.
Exactly. Different characteristics, different strategies. So where should we start?
Let's go with Prudential Financial, PRU, Financial Services Insurance, Retirement, Investment Management, based in Newark, NJ.
Right. The 2024 numbers mentioned show revenue over $70 billion. Net income over $2.7 billion, and wow, over $1.5 trillion in assets under management.
In the dividend profile.
Yield around 5.21% annually. That's $5.40 per share. Payout ratio is highlighted as being pretty high, around 85.29%. Dividend growth over the past decade averaged about 3.92% annually.
Okay, that payout ratio, 85%, the sources flag that, right?
They do. They point out it's high. Could raise concerns about sustainability if things get tough, but they immediately balance it by mentioning Prudential's strong financial position They also note a $2 billion share buyback program announced in 2024.
And where's the growth coming from?
A key driver mentioned is expansion into emerging markets, particularly Asia and Africa. That apparently helped boost operating profit in 2024, and they've got targets for more growth there.
So the takeaway from the PRU analysis, a higher yield, definitely, but that payout ratio needs watching, even considering their scale and that emerging market growth angle.
Makes sense. Okay, next, how about AES Corporation? AES.
Global Energy Company. Electricity generation, distribution. Based in Arlington, VA, operating in 15 countries. Highlighted specifically as a leader in renewables battery storage, solar.
Dividend yield here is around 3.4% annually. Now, interestingly, the reports say the payout ratio isn't publicly disclosed for AES. But they do mention a commitment to maintaining the dividend and a history of steady payments, occasional increases.
And financial health. Tied to renewables.
Yeah, the focus on renewables is framed positively in the material, involvement in big projects, partnerships with tech giants like Alphabet, Microsoft, Amazon, supplying them with renewable power that's seen as enhancing revenue stability.
Growth potential.
Huge opportunities noted in the global shift to renewables. Their leadership in storage and solar matches demand trends. The reports even cite a projection of 22% annual growth in data center energy demand through 2030 as a potential tailwind.
So what's interesting here is that direct exposure to the renewable boom and those specific tech partnerships. Lower yield than PRU, but plugged into a strong secular trend.
Exactly. A different kind of story. Okay, who's next? Verizon. VZ.
Yep, the big U.S. telecom, wireless, wireline, based in New York.
Dividend yield here is pretty high, around 6.22% annually, $2.71 per share. Payout ratio is around 65.46%, which the reports describe as fairly balanced. The dividend growth rate over 10 years is lower, though, about 1.89% annually.
Financial health. The payout ratio seems sustainable.
Yeah, suggests room for reinvestment. And strong free cash flow is noted, $19 billion in 2023, easily covering the $11 billion in dividends paid out.
Okay, but there's a but, isn't there?
There is. The reports flag this very clearly. What about the debt? Your material points to a massive debt load, over $150 billion, and about $16 billion of that is maturing within the next year.
Which means potential refinancing risk, especially if rates stay high.
Exactly. That's highlighted as a key risk. Growth is tied to 5G expansion, maybe acquisitions like a potential $20 billion deal with Frontier Communications mentioned, though analyst views on that seem mixed. Big 5G benefits are expected in 2025, though.
So, Verizon. High yield, good FCF coverage for the dividend, but that huge debt pile is the major caveat emphasized in the sources.
Definitely something to watch.
Okay.
Let's switch gears completely. Ladder Capital, LADR.
Yeah, this one's different. It's a REIT real estate investment trust focused on commercial real estate assets, loans, securities, actual properties.
And the yield here, based on the specific data provided, is the highest we've seen so far.
Yep, around 7.82% annually, but the payout ratio is, well, it's 112.27% based on trailing earnings.
Whoa, okay. Paying up more than net income.
Right. And the material explains this could raise sustainability flags, naturally, but it immediately gives the crucial REIT context. They have to distribute at least 90% of their taxable income. That often pushes the earnings payout ratio over 100%.
So it's not necessarily an immediate red flag in the same way it would be for a regular corporation.
Correct. But the sources still advise monitoring cash flow and earnings closely. Real estate market and interest rates. Their strategy focuses on risk-adjusted returns in that space.
So highest yield discussed, but that very high payout ratio, even with the REIT context, plus the market sensitivity, those are the key things highlighted for investors to track.
Makes sense. Okay, Dow Inc., DIW Material Science.
Right. Packaging, infrastructure, consumer care, electronics materials, based in Midland, MI. Their products are pretty integral across industries.
Dividend profile, yield around 7.17% annually, $2.80 per share. And the payout ratio.
This one's low, around 35%. Plus, the reports mentioned they've increased dividends for 5 straight years.
So that low payout ratio, 35%, suggests strong sustainability.
Yeah, that's highlighted. Plenty of room for reinvestment. Their diversified portfolio helps with stable cash flow. Though the sources note you still need to watch commodity prices and the global economy, given the cyclical nature of some end markets.
Growth is tied to industrial demand, innovation in materials, focus on sustainability and tech. R&D investments are key.
So Dow presents an interesting case in these reports. A high yield, combined with the lowest payout ratio we've seen detailed here, suggests strong sustainability potential, but still linked to those broader industrial cycles.
Okay, 2 more energy giants. Chevron first. CVX.
One of the biggest integrated energy companies globally. Exploration, production, refining, marketing, chemicals, the whole value chain. Based in California, global presence.
Dividend profile. Yield around 4.99% annually, $6.84 per share. Payout ratio around 75%.
And the standout feature mentioned.
That track record. Increased dividends for 38 consecutive years.
Wow. Yeah, that's impressive. The 75% payout is described as generous, but supported by strong cash flows from being integrated. That history really speaks to financial strength and commitment. But, like any major energy player, the reports stress the influence of oil price swings, regulations, geopolitics.
Growth influenced by energy demand, tech, and their own investments, including increasingly in lower carbon areas alongside the big traditional projects.
So CVX in this analysis, solid yield, amazing dividend growth history, a diversified energy play, but still carrying those inherent sector risks.
Right. And finally, Johnson & Johnson. J&J, healthcare behemoth.
Medical devices, pharma, consumer health, based in New Jersey. Operates across those three main segments globally.
Dividend profile. Yield around 3.37% annually, $5.20 per share. Payout ratio is about 54.76%.
And the dividend history here.
Even more impressive. The sources highlight 53 consecutive years of dividend increases, the longest streak among all these companies discussed.
53 years.
Okay.
And financial health.
Described as very robust, sustainable payout, strong cash flow, that incredible track record. Plus, substantial cash reserves and low debt levels are noted, giving them lots of flexibility.
Growth drivers.
Innovation, mainly in pharma and med devices. Expansion in emerging markets, focus on R&D and strategic acquisitions.
So what really stands out with J&J in this material is that unmatched dividend growth history combined with very strong financials. It offers a very different profile compared to, say, Ladder Capital or even Verizon.
Absolutely. Okay, wow, we've covered a lot of ground based on your stack of sources here.
We really have. So pulling it all together, what does this collection of material really suggest when you look at dividend stocks?
Well, it hammers home that dividend stock isn't one single thing, right? It's a huge category. You've seen yields here from J&J's, 3.37% all the way up to Ladder Capital's 7.82%, according to the sources.
And those payout ratios tell such different stories, too. Dow's really low, 35%, versus Ladder Capital's 112%, with that specific REIT explanation needed. Those ratios, as the reports highlight, give you a clue about how much is coming back to you versus being put back into the business, and maybe how safe that dividend feels.
And the growth drivers are all over the map. BKR's energy tech transition, AES riding the renewables wave, PRU and J&J looking at emerging markets, VZ pushing 5G, LADR tied to real estate cycles, Dow to industrial trends, CVX playing the broad energy market.
And with those different models come very different risks. Commodity prices for the energy guys, debt levels for Verizon, market cycles for LADR and Dow, geopolitical stuff for the global players like BKR, execution risk for companies in transition. It's all laid out there in the analyses.
Yeah, this material really underlines that picking a dividend stock can't just be about chasing the highest yield number. It's about digging into the business behind it, as presented in these sources, the financials, the market position, the strategy, and the specific risks they face.
Couldn't agree more.
So we've taken a pretty comprehensive look through your sources on these dividend stocks. We went deep on Baker Hughes's energy transition play and then compared the key metrics, stories, and risks highlighted for Prudential, AES, Verizon, Ladder Capital, Dow, Chevron, and Johnson & Johnson.
Yeah, hopefully this helps you quickly get up to speed on this specific material, pointing out some of the maybe surprising facts and the key takeaways that jump out from the analysis.
Definitely. And as you think about this whole spectrum presented in the sources, BKR's tech pivot, the incredible dividend histories at CVX and J&J, those high yields at LADR and VZ, the really varied payout ratios, it does raise a final question for you to ponder. Based only on the kind of information you find in reports like these, how might you prioritize these different factors, like yield size versus payout ratio safety, or growth prospects versus the company's specific risks? What kind of balance feels right for your own approach when looking at this type of analysis?